Hello champions, welcome back. Today we are going to demonstrate on the new day open model using live examples that I've just noticed happened today. And also I think this is going to be the last time I am going to touch on this model, the new day open. It's a very simple model. I have done a couple of videos on it before. I'll just show you on the channel. We have this, the new day open, open high low close and open low high close, did that. And these two videos where I was backtesting using a robot, and here I also saw explaining the simple and stupid strategy to trade forex or currencies and gold. I've also used the same thing here to demonstrate how you can flip accounts. So this model is based on a very simple concept, candle anatomy. By candle anatomy I mean open low high close and open high low close. Ideally every candle forms an open and then forms a high. As it prints the body, it forms a low and then closes. That is for a bearish candle. And a bullish candle opens, forms a low, then prints the body, forms a high and close. So you can look at this example. This bullish candle, this is the daily time frame. The new day open is NDO. NDO stands for new day open. So new day open opens here, comes, drops lower to form a low, and then prints the body of the candle, and then forms a high and closes, right? For a bearish situation, we have the body opening, form a high, and then drop to form a low, and then close. So that is why I said that is why every candle has a wick. Every candle has a wick, and that is because every candle will always open, form a high, drop to form a low, and then close, or open, form a low, then rise to form a high and then close. That is why every candle, 99.99% of the candles have wicks. So it is that simple. And today I have decided to demonstrate using some examples that I've seen happened today. And yes, so let's get into it. Also, I have said this is going to be the last time I'm touching on this model, so that people can now go out there and put in effort to learn and backtest these things, and also see if this is something they can implement in their own trading. Now, this is Euro JPY 1 day. This is the daily time frame. Today is Wednesday. Today is Wednesday or Tuesday. Today is Wednesday. This is the Wednesday candle. Wednesday, 6th of August. Now, what time is it? It is 9 p.m. East African time. So we can see we have this candle and this candle and this candle. Now, something you'll notice is this candle, no, this bullish candle swept the low of the bearish candle right here, and then raised and closed above the body of the bearish candle, right? And that also we have something happening. We have a fair value gap here where price is reacting off. You can see that. You can refine this a bit further right there. So this is the daily time frame. It might seem small right now, but if you go to the lower time frame, like the 30 minutes, the 15 and the 5-minute time frame, these are very huge range. So you can see as price is sweeping this low, it gives us a wick into this into this daily fair value gap, right? And then rises to go high. So this was yesterday, Tuesday, and then today, because of this reaction, we are expecting the next candle would be bullish. So, and that is what we have for the day today. So as the new day candle is opening, you mark that new day open, NDO, and then you want to look for now entries to go long because you are expecting price to go higher. There's nothing as sweet as having an expectancy of what price is likely to do. That is one of the things you need to have in your trading model or strategy. You need to form a bias you need to have a bias on what exactly the next candle might do. In our case, this is the Wednesday candle, which was today. Now if you mark your new day open, you want to go to the lower time frame. Maybe you can start with the 15-minute time frame and see what is happening. So you want to mark the exact point where the new day open formed, because where is it? This is Tuesday 23. Tuesday we had our new day open around here, so on this candle here. So it opened, we can go to the 55-minute time frame and just refine that area so that we have an accurate entry or an accurate area where the price opened. So that is exactly where price opened. I can zoom in a bit further and see where price opened. So this is Wednesday 00 at midnight. Price opens here, forms a low and goes high. But that is not our interest for this. What you want to see is, because you are expecting price to go high, we want price to make an impulsive move to the downside and then form a low of the day and then go up. And you can see, even without doing anything else, that is what happened. But now we want to know, how would we have gotten an entry into this trade? We have this open, price drops lower, then forms a bit of consolidation and drops lower. Now what happens is this liquidity sweep. We also notice where we have price reacting off this order block. This reaction of this order block is a sign that price is most likely going to go high. So what we want to see next is a break of structure. So we have this impulsive move to the downside, and then we have this break of structure right there, or market structure shift. You can call it market structure shift. This is a sell side liquidity swept. Now we have price going up, and as a result, now we have something happening. We have this breaker, the last up close candle before this move that swept this low. We have a breaker block there, and you can see price reacted off this breaker block, right? This breaker block giving us price closing above, then coming into the breaker block and going up. So what would you have done at this point? You would have taken an entry once price closes above this breaker right there, and maybe stop loss below that, because you do not expect, or stop loss below this point because you do not expect price to go below this point. This is a protected low because there's a market structure shift or a break of structure, and then a low formed, and then a high, a break of structure. So we do not expect price to get to this point, and then maybe you can target your 1 to 4, 1 to 5, 1 to 3, 1 to 4, 1 to 5. This one got to 3, 1 to 3, but we are not going to do that because our entries are tighter entries, tighter stop losses, and higher risk to reward ratio. So what are we going to do? We are going to look at where price most likely reacted off of the latest or the most recent a fair value gap. I love using fair value gaps. For example, we have this fair value gap here, right? Fair value gap right there, and price coming, dropping into this fair value gap and closing above. Now the next thing we have, I will go to the 1 minute time frame and show you something interesting for the day, something interesting. So we have price coming to this fair value gap, right? And also it is inverted, it is in the same area as this inverted fair value gap, right? You can refine that. This inverted fair value gap also is in the same area with this fair value gap right here. Inverted fair value gap, fair value gap. As it gives it a range name, I don't know what, I don't remember what that name is, but there's a name for it, where there is an inverted fair value gap and a fair value gap in the same zone or area. So these are three interesting occurrences: fair value gap, inverted fair value gap, and then another one, inverted fair value gap. So, but for this we are not going to consider it because price is now reacting off this the 5 minute fair value gap, right? And also this 1 minute fair value gap. Now so what do you see happening? We see price coming from here and then all the way to this point, giving us a good engulfing out of this fair value gap. Now one of the things my mentor has taught me is using weak entries or one candle CISD or one candle change in state of delivery, and I'm going to show you that. So we have this coming down and then price coming out and breaking above, going above this high here. You can see this bearish candle that dropped into our fair value gap, and then we had price now moving up and breaking above this small change in state of delivery. This one candle that gives us this change in state of delivery becomes of significant value. It gives us an area that we can work with. So what area are we going to work with? We are going to work with this wick of this candle right here. Now once price breaks above, we are expecting it to retrace into this wick and go higher. Now at the point where it retraces into this wick, this wick zone, I think it's called a propulsion block if I'm not wrong. We have price going up. Now immediately price gets into this area, we place our buys, our stops right below this candle that gave us this wick, this zone, or this propulsion block, yeah. So that, and then now this time we are not targeting a 1 to 3. We want to get a clean 1 to 10 risk to reward ratio, and I want to show you how that happened very fast. Yes, so 10 10 10 10 10, yeah, something like that. So this is the 1 minute time frame. You can see you already have a 1 to 10 entry triggered on Wednesday at 8 a.m. and take profit hit at 9 a.m. This is a cool 10 risk to reward ratio, and because it is still early in the day, we are expecting this day to go even higher, very high, or even higher, right? So that we have a full day of trading. For example, it's around 6 p.m. This is UTC 6 p.m. And price is way up there, so closing here would have been a bit early, so maybe we would have taken a 1 to 20. All right, let's maybe target a 1 to 20 because this one will not give us a good, yeah, yes. So 1 to 20, maybe 1 to 20, something like that. So we have that, and 1 to 20 we had it coming. Maybe you were saying I want to be a bit more conservative, move my stop loss to this point here. Why would you want to move your stop loss to this point? It is a protected low. Why? Because we have this price going up, sweeping, breaking our structure, breaking structure at this point, then coming lower, reacting to this fair value gap and going higher, giving us a high that sweeps this, or gives us a break of structure and then drops and then goes high. So our stop being here, it is a very safe spot to have our stop loss. So even if price retraces, don't expect it to get that deep. So this is a 1 to 11.72. We can have a look at exactly price triggered, trade triggered at 8 a.m. on Wednesday, and by 10 a.m. we had our 20 or our 10 are being tagged. So this is an example on Euro JPY. Let us go look at the next example. So this is Euro USD. We had price doing almost the same thing. So we want to look at what is happening, right? So this there, Euro USD 1 day daily time frame, same thing happening. The first thing is you have this bearish candle, and then we have this bullish candle, but before it became bullish, it swept the low of this bearish candle and went higher, closing above. So the Monday candle bearish, the Tuesday candle sweeping the low of the Monday candle and then closing high. And also, so we have this liquidity sweep, and also I want you to notice something. We have this massive fair value gap right here, right? So what does price do? It tags into our fair value gap and forms a rejection candle above it. So what was the expectation for the day? The expectation for the day is this new day open candle, which is Wednesday, was going to go high, and that is exactly what has happened. So immediately you wake up and see this has happened. Now you want to mark your new day open like that, right? And then you can do this in the 5-minute time frame. I'm just doing this in the higher time frame for demonstration. So going to the 5 minutes, we want to see what was happening. So first of all, you want to mark the exact point where price opened, because that is what you will do when the new day is opening. So Wednesday at what time is this? I think this is the candle. No, this is the candle. This opened here, went high. Yes, so Wednesday opens. So because you're expecting price to push high, we want it to drop low and form the low of the day and then go up. And you also have several confluences that will support price going higher. So we have this move to the downside, we have this low swept, and you will notice something. There is a 5-minute fair value gap here where price is likely reacting off of, right? So because that is happening, price closes above this fair value gap, and then we have now massive impulsive move to the upside. Now as price is moving to the upside, we want to get a break of structure or a market structure shift. We have a solid market structure shift at this point, right? Now this point we have this happening, and now we are expecting price to react off of something and then continue pushing higher. So it gives us a market structure shift and then drops. So looking to the left side, you will see we have several fair value gaps. We don't know which one would hold value, right? and we want price to react of a fair value gap first before we do anything meaningful. Maybe you want to use this fair value gap, but you see price did not do that. You can see price went straight lower, so that did not hold value. Which other fair value gap would you have wanted to use? This inverted fair value gap, same thing happened, price pushed lower without reacting off of it. When you see this happening, you have massive several fair value gaps. You want to use a dealing range to determine which price, which sets of fair value gaps or inverted fair value gaps would hold value. As a result, you will want to bring your Fibonacci tool, draw from the low of that range to the high of that range, and then you want price to react off a fair value gap below the 50 or the 5%, 0.5% going lower. If you are familiar with dealing ranges, this is the discount zone, so we only take buys in the discount zone. As a result, the next thing you want to do is to look for fair value gaps within the discount zone where price is likely to react off of. So we have a few. We have this. First of all, let me just go to the 15-minute time frame. We see if we can get one clear fair value gap that price is going to react off of. Sorry, a clear fair value gap where price is going to react off of. So this is my this is my what? This is my 15-minute 5-minute dealing range, this discount zone. So we have this fair value gap, right? And that is where now price is reacting off of. So you want to have a look at the 15-minute time frame, the 5-minute time frame for your fair value gaps where price is likely to react off of. Now now you have this happening. Once price comes to this fair value gap, you want to take an entry there. Stop loss below that fair value gap, or you can put it below this point because it is a protected low. Maybe 1 to 4, 1 to 5, because now that is a very wide stop, right? This one is still giving good ratios. It has so far gotten to 9, but maybe 1 to 4, 1 to 5, 1 to 3, 1 to 4, 1 to 5 because of the wideness of the stop. But as I have said, we are using a different entry model for our entries. So let us see what is happening in the 5-minute time frame. Price comes into this fair value gap, closes above. It gives us a propulsion block right there. I don't know if you guys can see it, but it is right there. Give it a different color. And then we go into the zoom in a bit, and yeah, so we have this candle that is our entry. So this propulsion block is where our entry is. So take an entry there, stop loss below this at this point or below that point, and you can tell already this was not, this setup did not give us something, just a 2R and then reversed, right? So since it reversed, we are not doing anything else until we see another reaction, and that is what we have here. Now this one had a solid reaction of this fair value gap. So we have entry into there, the fair value gap, and then engulfing candle out of this fair value gap, and then this gives us a propulsion block where we are likely to take our entries, right? So again, this massive candle goes up, the next candle opens and drops. As it is dropping, we have our sell limit, our buy limit placed at that point, stop loss below this point, and we want to target that 10R, 15R, 20R. So let us see if it gives us that. This video is becoming a bit long, I did not intend for it to be that long, but let us see. So 10R tagged, we see at what time it tagged. This is the 8:45 on Wednesday, and at 12:40 our 10R was tagged. Let us see if it goes to 20. Not yet to 20, but yes, so that is what is happening. Anyway, that is the propulsion block entry, or what my mentor calls 1 minute or 1 candle CISD, or 1 candle changing set of delivery. There is another model you can use for your entries. This is not illegal, you can still do it. You have price doing this, giving us this engulfing and this change in set of delivery using this candle. So this candle gives us a one candle change instead of delivery. So what do you want to do? You want to mark a dealing range on this candle right here up to this point, right? And then you wait for this bearish candle to tag into the 50% of this dealing range, and that becomes your entry, which is pretty much almost the same entry as the other one. Stop loss below that are low, and take profit. You want your 10R, 15R, 20R, and that is the trade for Euro USD. Yeah, good. But did we have a trade here? I don't think so. Let's check US Tech 100. What about this? No, it was not on USD JPY, not on gold. Euro JPY is when we have Euro USD GBP. We had a setup here, but I can't remember the exact. Anyway, so those are 2 examples. I want you to go have a look at them. We also had a setup here. I just can't remember how I got it, but there was a setup in this area. Anyway, I hope you've seen that, you've learned something. Maybe I can still use this to see if we can get an entry on this candle here. So fair value gap, daily time frame, price bullish candle sweeping the low of the previous candle, right, and closing above, and then the next candle, which was on Monday, gives us a dealing range. Let us see if it can give us a setup. So new day open, Monday NDO, go to the 15 minute. I think 15 will be the best, so that we can get this point earlier. So we are expecting a bullish bias. So let's see what we have. Friday, Monday, can use this, right? So I think you can see that happened, though it did not happen on that day. 5 minute time frame. Okay, looks like we can't access that data, can we? 5 minutes. We are trying 5 minutes. Yeah, so this will not give us. We should be able to access that data. Yes, there you have. So expecting a bullish bias. Monday, impulsive move to the low, break of structure, dealing range. What do we have here? Price is reacting off this fair value gap, giving us what? Giving us a 1 change instead of delivery at this point, right? You can see bearish candle, 2 bullish candles, change instead of delivery. This one did not have a wick, but you can use that dealing range to determine where price is likely going to react off of. So we are expecting price to react off from this area right there, right? This is the 5-minute time frame, and entry at the retest of that area, stop loss below that, and our target is 10R. Let's see if it gave us a 10R. It did not give us a 10R. That was Monday, and the all of Monday was just consolidating even without hitting our stop loss. Right? So Tuesday or Monday, Tuesday opened at this point, so that was a terrible day, I can say. But if you took partials at 5R, you are good to go. Anyway, so that is the NDO or new day open a model. You can have a look at it. You want price to react off a higher time frame, the daily time frame, fair value gap, giving you a reason why you want price to move, why you expect price to move to where you want it to go. So have a look at it, back test, forward test, and see what you can do with this information. All the best. Have a happy trading time. Bye bye.